So moving on to the second panel right away without any break. We are very dedicated. We want to bring this to you as efficiently as possible. Basel III was agreed upon by the members of the Basel Committee and the Basel Supervision in November 2010 and was scheduled to be introduced from 2013 up to 2015. However, the implementation was extended repeatedly to 2019 and then lately again to 2020. Now, the implementation of Basel III agreements in the European Union has been a legislative package comprising of CRD4 and CRD5 that we've just discussed on the previous panel, and on prudential requirements for credit institutions, or as we call them, the CRR. One of the OECD studies released in 2011 estimated that the medium-term impact of Basel III implementation on the GDP growth would range between 0.05% negative and 0.15% negative per year. Copenhagen Economics estimates that the higher capitalization will increase the annual cost for European banking customers to around 40 to 45 billion euros in the form of higher lending rates and fees. While looking at this, they also estimated that the average increase of between 0.12 and 0.16 percentage points in lending rates to customers would be expected as a result. They have also estimated that for a typical mortgage holder in Europe, the cost of implementation of Basel III would be around 4,400 euros on average. A study from BIS in 2010 finds that the additional benefit for advanced economies of increasing the capital ratios above 15% in terms of reducing the risk in crisis is very small. Similarly, the IMF estimates 85% of all banking crises in OECD countries since 1970 could have been avoided with total capital ratios of 15%. I think this connects to what we have heard in the first panel, where the optimal capital ratio was between 13 and 14, if I remember correctly. They also state that the marginal benefit of additional capital declines rapidly after that, after 15%, as further capital increases only have a marginal effect on the prevention of different types of crises. Now, there is a paper published by Copenhagen Economics, and we do have a panelist from that institution on this panel, which was named the EU implementation of the final Basel III framework and the impact on the banking market and the real economy. And what they do say is that the final Basel III framework is one of the most debated regulatory frameworks in recent years. The accord was supported by the G20 finance ministers and central bank governors meeting under the condition, and I quote, "We confirm our support for the Basel Committee on Banking Supervision's work to finalize the Basel III framework without further significantly increasing overall capital requirements across the banking sector while promoting a level playing field." And in their conclusion of this paper, they say that if this is to be implemented one-on-one, as outlined by the EBA's main scenario, it is not consistent with the G20 mandate, nor will it provide the net benefits to the EU economy. They've also suggested some 4 different steps towards a proper implementation, which are just mainly output floor, unrated corporates to be subject to relatively higher capital requirements. The EBA impact assessments provide several options on how the impact of capital requirements can be limited, and a revision of the EU-specific capital buffers could also be considered when implementing this whole package. So to start with the panel, I will introduce our first panelist. His name is Mr. Mario Quagliarello. He is the Director of the Economic Analysis and Statistics Department in the European Banking Authority, so a very relevant panelist for this discussion. The department is in charge of the analysis of risks and vulnerabilities of the EU banking sector, as well as the stress testing function in the EBA. The department also holds a responsibility for all the statistical tasks carried out in the EBA, including data dissemination. Mario has published several articles in the Italian and international journals, including the Journal of Banking and Finance, Journal of Financial Services Research, Journal of International Financial Markets, and others. He holds a bachelor's degree in economics with honors from the University of La Sapienza in Rome, and a PhD in economics from the University of York in the United Kingdom. So, Mr. Quagliariello, yesterday the EBA published a preliminary assessment of the impact of COVID crisis in the EU banking sector. There were 4 or 5 main conclusions from that report. I'll just briefly go through them, and I'll kindly ask you to just maybe give the audience a little bit more on what was published yesterday. You say that banks have entered the COVID crisis more capitalized and with better liquidity compared to the previous global financial crisis, 2008. The COVID crisis will have a negative impact on the asset quality. Banks have been using their liquidity buffers and are expected to continue using them in the coming months, and the bank's operational resilience is under pressure. Would you be able to just walk us through what you have found in this document, and also give us an idea of how successful and flexible have the Basel reforms been in this current crisis?
Yes, thank you very much, and thank you for the invitation to this panel. Yes, actually, what I was planning to do was to cover quickly the findings of our report, but reading the results as a sort of test for the Basel agreement, and then mentioning a couple of next steps and some conclusions. Now, I think you mentioned many of the impact assessments run by, let's say, European institutions, global institutions, and also the private sector. I would have the temptation of start arguing on the assumptions of some of the impact assessments, especially the ones, let's say, very negative on the impact on lending, on the cost of funding, and so on. Clearly, we have different conclusions, but I would, let's say, stick to my speaking points and try to avoid the temptation. So the first point I would say is, I think this crisis is a good test for what has been achieved by global regulation and also the European regulation. This has been mentioned already by many of the previous speakers. I think Matias Cabrera at the beginning mentioned all the, let's say, new elements of the Basel Accord. And let me give you a couple of numbers based also on the report we published yesterday. I think clearly the key message we are giving is that banks are facing this crisis in a much better shape than they were at the beginning of the great financial crisis. First of all, there is really, let's say, no comparison in terms of the level of capital. The Common Equity Tier 1 ratio was 9% in 2009, and this is, of course, a proxy of the closest possible definition of capital available at the time, and it was close to 15% at the end of 2019. By the way, this 15% is a number which is coming more and more as the ideal capital level. I mean, I would say just by chance, this is the number on average for the EU banking sector. And of course, this is well above the capital requirements, but I will elaborate a bit more on this point. The LCR, the liquidity coverage ratio, which was another, let's say, innovation of the capital accord, was at 150%. Just as a reminder, let's say the target ratio should be 100%. And by the way, in crisis times, banks are allowed to go below the 100%. There is a lot of buffers before reaching 100%. And there was a clear message that banks can also go below this target if needed during the crisis. And I think the most important element of all of this is that banks are holding, in addition to the capital requirements, an additional voluntary buffer, what we call the management buffer. So what is above the overall capital requirement, so all the capital requirements plus the buffers and P2G of around 300 billion. Which corresponds to roughly 300 basis points of risk-weighted assets. So this is an amount of capital which is held by banks based on their own risk appetite that can be used for covering losses or providing credit to the economy in crisis times. And I think the very strong capital position of the banks, which, as I said, is the result of the gradual adjustment to the Basel objectives, as the benefit of having banks in a better shape for facing the crisis, but also competent authorities and supervisors more willing to make use of the flexibility embedded in the regulation. And I think probably this is the first time and the first test for the, let's say, counter-cyclical package also included in the Basel Accord. And I think the authorities, the regulators in Basel, but also in Europe, have demonstrated to be very quick and coordinated in responding, and to be honest, also quite brave in making some quick and very clear-cut decisions. So on the one hand, there was a clear call from all the supervisors in making use of the flexibility already embedded in the capital regulation, using the buffers, and in some cases, when it is possible, to switch off the buffers or reduce the buffers. This happened for the counter-cyclical buffer. In addition, in Europe, we also clarified that part of the Pillar 2 requirement can be covered with instruments other than CT1, which of course is helpful because it's freeing up, let's say, better quality capital for covering losses. And at the same time, we also ask banks to avoid the distribution of dividends, because of course the idea at this stage is to be, on the one hand, very cautious and being sure that there is enough capital in the banks, since it is early stage of the crisis, but also for giving the signal that banks are putting, let's say, customers and the economy first, and the shareholders just as a second stakeholder. I think has been said many times, this time is different because the banks are not, they don't have any, let's say, responsibility in the crisis, but at the same time is good for them to show the willingness to be part of the solution. And if you look at the all measures we took, this has been very beneficial in terms of creating, in making available additional capital. If you look at the relief of the buffers, the request to banks to hold, to reduce the, to use a P2G, and also the possibility for banks to go below the overall capital requirement, these all set of actions make the banking sector able to withstand losses and then providing credit. Just looking at the measures which are, let's say, a concrete relief, meaning the reduction of the counter-cyclical buffers, the dividends remaining in banks' balance sheets, and the P2R changes, there are another 100 basis points of capital available for covering losses. And if you also consider the possibility for banks to operate below P2G, which has been one of the statements by some competent authorities, especially the single supervisory mechanism, this makes a total of 200 basis points of risk-weighted assets freed up as the results of the measures put forward by the competent authorities, which in practice means that banks are currently having 500 basis points of management buffer above the overall capital requirement. So before even triggering the MDA, they have 500 basis points of capital to be used. I mean, of course, this is an average, so we need to look bank by bank, and there are, of course, banks which are better or less well capitalized, even though if you look at the distribution of the CET1 ratios, but also of the leverage ratio over time, the old distribution moved up. So also the banks with a lower capital position after the crisis increased the capital position. But of course, again, dispersion remains. And just for giving an idea of the, let's say, absorbing capacity of this capital, we also have in our report a very, I would say, simplistic but still informative sensitivity analysis, in which we applied the transition rates for credit risk banks provided during the 2018 stress test, which of course was based on very different assumptions and a different scenario, to the starting points in 2019. And in addition, we also added some extra shocks for the sectors more affected by the crisis and for the countries more affected by the crisis. And overall, let's say in the worst case, we have credit risk losses of around 380 basis points of CET1. So this means that, I mean, this is the number to be compared with the 500 basis point of management buffer. Now, in the report, it is plenty of, let's say, caveats and disclaimers on the methodology we used, on the fact that we are just considering credit risk, not also the other risks. And also, on the other side, that we're not considering the possible beneficial effects of moratoria, public guarantees, and other elements which could mitigate the impact of the crisis. So I think all these numbers should be taken not as point estimates, but more as a first ballpark figure for understanding the potential losses. But I think what is a fact is that banks are currently holding 500 basis points of capital above the overall capital requirement. Which means in practice that they can not only absorb losses, but also provide lending to the economy, which is key. Now, once again, this is an estimate we are making, so take these numbers as tentative and preliminary, but depending on the sectors towards which banks can expand the lending, let's say the lending potential of the management buffer after considering the credit risk losses is between 600 billion and 1.3 trillion of additional lending, which is, let's say, a substantial share of the existing loans to the households and the non-financial corporations. Once again, I would like to reiterate many times the fact that these numbers are averages, and also that they are very tentative given the uncertainty on the evolution of the economic conditions, but still I think they are quite indicative on the, let's say, success of the capital increase, the liquidity increase due to the Basel Agreement. So again, very often we end up speculating on, let's say, future impacts and numbers. I think now we have a first test of how effective the capital increase has been and how beneficial it can be for banks in dealing with a crisis like this one. Now, on the next steps, I will, let's say, be brief, but I would like to mention just a couple of points. One is, implementing Basel after, let's say, many years of discussion, and when I say Basel, I mean the December 2017 agreement. So let's say output floor and all the other elements, which are the, let's say, the most controversial, is very important for completing the reforms and also for acknowledging that the Basel Committee managed to find again consensus and a good compromise for having global reforms applied consistently and ensuring the level playing field. From the European perspective, I think it is very important to be loyal in the implementation of the accord, because the credibility of the banking sector is at stake if we do not. I think I mentioned already in previous occasions that in the RCAP that the Basel Committee and IMF are running, we have been found for some aspects of our implementation of the previous accord materially not compliant. And of course, this has always an impact on the credibility of the sector and in practice on the, let's say, on the rating of the sector. So it's not something which is theoretical, it's just a discussion among policymakers. Not being compliant means that the investors are reluctant to invest in European banks. This means that the cost of funding is higher, and this means that the share prices tend to be lower. So for the sometimes little benefit in terms of capital relief, we take a big cost in terms of the credibility of the sector and the overall appetite of investors to come back and invest in European banks. And at the same time, we keep focusing in the European discussions on what we don't like of the December agreement, but there are several elements which indeed are, let's say, consistent or are going in the direction of the European regulation. I can mention the fact that the standardized approach gets more risk sensitive. I can mention the fact that the treatment for SMEs is getting closer to the European approach, and also that the treatment of the covered bonds, which was, let's say, not existent in Basel, has been very much based on the European approach. Now, you mentioned already in your introduction, Danny, the fact that there is discussion on whether tighter capital requirements can reduce the bank's ability to lend. Now, once again, there is plenty of literature, probably you know more than I do, and in a normal, let's say, normal times, I would mention some of these literature, but for me, the key figures are the ones I presented earlier on, which is better capitalized banks are in a better position to provide lending to the economy, and if the supervisors are dealing with better capitalized capitalized banks, they're also more open-minded to release buffers and being more flexible in the implementation of the regulation. Now, I'm sure that the next speakers will mention their own impact assessment. I don't want to enter into this sort of debate on which is the best impact assessment, but I would like to make 2 points. One is that our impact assessment, which has been based on largely on the inputs of the European Central Bank, shows clearly that there is an adjustment period and an adjustment cost, but the long-term benefits in terms of crisis prevention and the impact of the crisis is superior to all the short-term adjustment costs. And also I would mention, again, there is a tendency to overestimate the impact. What we have seen is that, let's say, our figures based on banks' submissions are already conservative, and banks tend to err on the conservative side if they don't have enough data or reliable data for estimating the impact of new pieces of regulation. But at the same time, when they report to the investors, they tend to be much more positive. So I think we should be very careful when we look at the data, because I think perhaps there is a different approach depending on the stakeholder. Banks are very conservative when they talk to the supervisors, very optimistic when they report to the investors. So probably the truth is a bit in the middle. Now, last point, and then I will finish, promise. As you know, there was an agreement to delay the implementation of the Basel Accord by 1 year, which I think is an acknowledgement of the practical challenges, operational challenges for banks and also for supervisors. In my view, this shouldn't be the chance or the temptation to start reopening discussions that took a long time for being closed and agreed. I think again, the response of the supervisors to the crisis has been quick, determined, and quite brave. But there have been a lot of efforts for allowing as much flexibility as possible in the implementation of the existing rules. But as I said, this is not a chance for rediscussing elements of the reforms that banks never liked. And by the way, elements which do not have anything to do with the crisis. So there is really no reason for discussing this once again. At the same time, I need to acknowledge that, of course, this crisis can be, this crisis can teach us additional lessons. So we should be humble and not pretending that there is no need for any changes. One coming to my mind is this issue of the usability of the buffers. I think the Basel framework is counter-cyclical. I think the authorities have proved to be counter-cyclical and to be, again, keen to test this counter-cyclicality in the regulation. Now it is to be seen whether the banks will be counter-cyclical. So they will, let's say, take the risk of reducing the capital ratios and increase lending, and if market participants and investors will accept capital ratios going down. Because again, from the supervisory community, it was clear. We accept the buffers to be used, which means we accept the capital ratios to go down in the next quarters. But again, since capital ratios are also a bit of a beauty contest, we need to see whether this is actually done by the banks. And I think, again, this is one element that, if doesn't work, could require some additional questions. And very last message is, what is very key at this stage is not to touch the risk metrics. So I think it is fine to, let's say, lower the bar for some of the key indicators, like the capital ratios can go down, the liquidity ratios can go down, but we shouldn't touch the risk metrics. So we cannot say that NPL is no longer an NPL because we are in a crisis, and we cannot say that the high quality liquid assets are now less of a high quality because we are in a crisis. So this is key, that we don't start changing the risk metrics, because this will put us in a couple of years in a condition of not being sure of what is in banks' balance sheet. And I will close here. Thank you.
Thank you, Mario. Indeed, I think your presentation was very informative on one side, but also reassuring for a wider audience, all of those people who are in any way connected to this industry. I think you've managed to bring this latest publication that you've had and how resilient banks really seem to be in this tough times. Just to reiterate, if I remember it correctly, you said that the expected effect, please correct me if I'm wrong, would be about 380 basis points, and this is an average figure, a median figure, right?
Yes, sorry, I was trying to unmute. Yes, this is the average figure. Yeah.
And if I've seen correctly in the report, the interquartile range is between 250 and 450 basis points, depending, of course, on the bank, right?
Yes, for this sensitivity, okay. Yes, it is. Yeah.
Okay, thank you. Thank you, Mara, very much. We will move now to what I expected to be a little bit of a different view, which is, of course, going to be good for this discussion. I'm going to bring in Mr. Sigurd Ness Schmidt, who is the partner in the Copenhagen Economics, where he heads the service areas in energy and climate, public finance, and financial regulation. Prior to Copenhagen Economics, he worked for the Danish Ministry of Finance, OECD, and the European Commission. In Copenhagen Economics, he provides consulting services to public and private clients with a focus on energy policy, public finance, and policy evaluation. In addition, he has been a project manager for a wide range of clients, particularly in Denmark, Sweden, Germany, Netherlands, and EU. He's a member of a study group of a public finance of the Germany Ministry of Finance and the policy fellow at the Public Finance Institute of FIFO in Germany. He has a vast experience in the project management in private and public organizations with a strong focus on energy and climate policy related areas. He holds a master's degree in economics from University of Copenhagen, has taught economics both at University of Copenhagen and Copenhagen Business School. Mr. Schmidt, just a month before the COVID-19 outbreak in November 2019, Copenhagen Economics published a document named EU Implementation of the Final Basel III Framework, Impact on the Banking Market and the Real Economy. There were two questions in that paper, if I remember correctly. One of them said, does it really fulfill the G20 mandate? And will it deliver the net benefits to the society? I hope this fits into whatever you've planned to tell us, but if you can try to touch upon this a little bit. I know that you have some of these touching points in your presentation. If you can please bring this forward in front of our audience, we'd really appreciate that. Thank you.
Thank you much. Can you hear me? I have a presentation. Can you see the presentation? Okay. Yes, I certainly hope to that my presentation will fulfill the ambition to focus on those. In fact, that is the frontline three issues I have here on the slide: conformity with the 20 mandate, discussion about net benefit to society, and some options for implementation. Let's see where the most interesting parts are. So first, the first one is the underlying aim behind the T20 mandate was reducing excessive viability in risk-weighted assets. So this whole concern about internal risk models mispricing risks. What we have noted is that there's a range of studies by EBA, by study groups under BIS and also the IMF that all come out very much with the same message, that the risk models used by the banks that are relying very much on these are, generally speaking, spot on. And if anything, they are tending to err on the conservative side. Also, as you know, there has been an ongoing exercise within the ECB called the so-called TRIM exercise, which is focused upon increasing the transparency and improving, let's say, ensuring that the methodology around pricing risks are becoming more common across banks in different jurisdictions. So the first thing is there's some basic issues around whether we do have a problem with the ERB models, and that's basically linked to the entire output floor discussion. So I think the first issue here is no, the proposal coming forward will not reduce excessive viability in risk-weighted assets to the extent that regulators actually want risk assessments that are conforming with actual risk in the market. And so I'm pretty convinced that the proposal going forward here will increase, not decrease, the distance between actual risks and the capital requirements that are set against these risks. And I think that's a problem. And I think it is accepted by a number of actors in the market. So here, first test failed. Now, then the second thing is it promoting a level playing field? Here we have made some, and here was not a major part of exercise, but I think we have a bit the feeling that the bank losses among the banks that are mostly hit by this piece of regulation, that is of course the banks that are using to a large extent internal business models. These were in fact banks that as a whole had relatively low losses during the crisis, which is consistent with what I just talked about before. There's no major discrepancy between the risk inside these business models and the actual cost of losses. By contrast, the losses in the US was much larger, and that is linked to two factors which I have discussed below. The first is that we have Fannie Mae, Freddie Mac had huge losses, and also there were huge losses in the US linked to bonds that were below AAA. So that really is a clear signal in the US market that the losses were concentrated at bonds that had substandard rates, while basically AAA rated bonds US came out not as good as the best performers in Europe, but reasonable. So this just raised the question, a universal approach to making risk reductions, are they really making sense when we are talking about markets that have fundamental different structures providing credit to the market? And I would suggest that as parts of the US mortgage market, particularly those related to the two government institutions, are still unregulated, still a missing piece. So I think here there is a case for going back to the question, is it really meaningful to have a one-size-fits-all approach to regulating risk when the underlying real risk in the market are so markedly different across different continents and also within EU? So I think I have a big question mark around this. The third point is, without the third part of the G20 amendment, without further significant increasing overall capital requirements, I mean, this is simply not fulfilled. Now, there is a genuine discussion about here what should be the numbers to look at. In our report, we took at face value the MRC shortfall as estimated by the EBA. We came up in our analysis with some roughly the same numbers, but we didn't want to open discussion on this. But the question is, how should these output floors in particular apply to the capital requirements above the minimum levels? And if you accept that the market buffers is also something that will be targeted, then the capital requirement will be much larger. This is linked to a larger discussion on the extent to which, and I think that's also acknowledged by the EBA report, that it's up for discretion at the national level to then reduce national decided levels buffers. But I don't think that's the right way to regulate at the EU level, to leave that up to too much to the national discretion. In any case, we think it is a genuine discussion to say, is the EBA proposal consistent with the aim of not increasing overall capital requirements? So I think we have question marks around all three G20 mandates. Now, that directly links to our next part of it, namely, we have some significant impact on interest rates. And these are done by very standard methods. We haven't invented something ourselves. We're using cost of capital estimations that is close to what BIS and others has used beforehand, and then we're coming up with these estimates. We have also done that is impact on lending rates, and not surprisingly, it goes up in particular for corporates and SMEs, and also for retail mortgage, somewhat depending on which market you are in. Now, then we come to the $10,000 question here. What are the real economy costs? Now, we have done a calculation in the EBF, the report we did for EBF, which is based on the EU average. So discussing, taking as the original work, and that was reconfirmed also in the IMF report, that a capitalization rate around 15 is a kind of an optimal, that is close to where the EU banks are as a whole. And then based on that, we suggest that this will have net negative benefits. But I think that is a very positive way to present this, because the banks that are being impacted by this proposal, that is specifically targeting the ERB models, they have as a whole capitalization rate that is way above these levels, And we have here for this specific presentation suggested that this will bring their capital ratios to close to 20%. So it's not here relevant to look at the average impact on the EU, because the use of ERB models are used, to be honest, mainly Northwestern Europe. It's hardly used in Eastern Europe, and it's used in some countries in southern part of Europe, but it's to a large extent concentrated in some banks in some countries. And those are the ones who are being mainly behind the big capital increases. So that needs to be figured into any specific calculations. How is the cost-benefit analysis in the countries, in the banks that are being mainly affected by this? Then we also hear, maybe this is a bit technical, but we have tried, and I would really love to have a more one-to-one discussion with EBA on a separate day. We have tried to understand a bit what is behind the EBA calculations, and we have some question marks. We have tried to be very transparent about how our calculations are done, and I think the main issue is probably around this: what are the net benefits of the package? I like to just do what I call a deep dive for Sweden, because of course we have not done a specific study for Sweden, but just to understand a bit the intuition. So we have looked at the two banking crises in Sweden. There was one early one in 91, 92. It was not really a banking crisis, it was an economic crisis. All analytics around this has shown this was a complete misalignment of fiscal policies, monetary policies, structural policies. But of course, this disaster also led to a banking meltdown. And we have provided some key numbers for this exercise. So this was the largest crisis in Sweden's history since the Second World War. Then we have, for Sweden again, the global financial crisis here in 2008 to 10. And that also, of course, led to capital losses, also some losses of GDP. And then what we have done is to say, okay, the EBA assessment is implicitly saying that raising capital ratios even further for Sweden, which has some of the highest capital ratios in Europe, that would significantly reduce any kind of risk. And then we have looked at the EBA stress test for Sweden. And even though these have an impact on GDP that is even almost exceeding or the level of the worst crisis in over the last 40 years, the loss of capital of the banks will still not bring the Swedish banks anywhere close to insolvency. It will just bring them back to capital ratios around 10-15%. And why would that be a reduction of capital ratios that would trigger a new recession? Before they lost that kind of money, there will be a lot of opportunities for Swedish banks to recapitalize, to adjust kind of the business operations. So what we are saying here is that we completely accept that the recapitalization of banks after the 2008 crisis was really beneficial to the economy. That is beyond dispute. Capital ratios were really below what they should be. And a situation where countries are facing a new crisis with rates of capitalization that is too low, there's a big risk that they react to the crisis not by seeking new capital, but by basically hoarding their capital because they are afraid to go to the market. We have much more difficult to see that banks that have high levels of capitalization already when a crisis sets on, that loses moderate amount of capital, that's a kind of situation where increasing their capital even further would have a major impact on the probability of recession. So what I really want to encourage in a debate about this going forward is to have a more intuition-based discussion on how come that these further increase in capital will really reduce risk of a deep recession in the countries that are mostly affected by it, looking at the health of their economies, look at the health of the banking situations, and not more theoretical papers around this. So that is a debate I think would be meaningful to have going forward. And again, also bearing in mind that if it was true, and I sincerely believe that it was so true that the internal risk models were really seriously underestimating the risk, then of course it would be safe to say that the capital ratios as measured currently by current rules were too optimistic. But the whole premise is that the current ratios are not too optimistic because the internal risk models are by and large fair. So these are genuine increase in capital ratios to levels that we believe are so high above optimal levels that we have difficulties identifying the real drivers of reduced risk to society in terms of economic crisis. And therefore, in our perspective, the costs dominate. And I think here we need to think about cost going a bit beyond our standard descriptions, because we also know what happens if some parts of the financial system are facing higher and higher capital charges, credit flows from other institutions that are not regulated. And we have seen that also in Sweden and other countries. So it's not cost-free to push one particular part of the credit market to higher standards if you are not also looking at other parts of the market. So there's also kind of a leakage risk here in terms and regulatory arbitrage. I think that is the kind of discussion we encourage to be had in Europe, respecting that, yes, we need sufficient capital buffers. They have been well established by the literature. Think about whether the countries that are particularly affected by this will really be helped by this and hence also being beneficial. So this is, I think, the thing you need to discuss before you look at what to do. But we have also here in the last slide come up with some options. And some of these options are already including in the EBA's own options. It could be maintaining the support factor for SMEs and some other options. It could also be removal of the systemic risk buffer. It could be dealing with the unrated corporates. I think this is also an area where the level playing field argument goes wrong, because we know that in the US, corporates, even a relatively small scale, very often have a credit rating. They don't, even very solid companies in Europe don't. So yes, we are applying the same model, but we are applying it to markets that are very different. So hence, we also suggest something to do with how to do with unrated corporates. And then we also suggest what we call the backstop approach. And I think that would be a measure we see completely conforming with international standards, because we suggest that the output floor, to the extent that is fully implemented, only applies to the capital that is regulated at the international level. And it should not apply to different kind of buffers that either the EU or member state had added on top of the international regulated buffers. That could lead to a substantially less increase in capital. I'm not saying that that is a justified increase in capital, but at least we have contained it. So my final recommendation would also be to look again on the work taking place at TRIM, ECB, look at the nice work done by E about looking at the risk associated with EIB models, and then trying to develop a long-term framework where the capital banks are setting against the losses are really consistent with what are likely default rates, because otherwise we'll see a banking system where there's disconnect between the real risks associated with the loans and the capital that's set aside. And that will lead to new risk misalignments. I think also different kind of regulatory arbitrage, and I don't think that's good long-term for the European banking system. Thank you very much.
Thank you, Mr. Schmidt, very much. So good to hear an opposing opinion to what we have heard this morning. And I think your call for a one-on-one with the EBA would be something we would all be very interested to hear. So please let us know in case you and Mario agree to face your arguments. We'd be more than happy to take part in that discussion in any kind of format. Thank you indeed for your detailed presentation of the paper. That was very interesting for me to go through preparing for this panel. We'll move to our next panelist. Her name is Veronique Ormezano. I hope I'm pronouncing that right. Veronique is a head of Group Prudential Affairs at BNP Paribas since November 2015. She's responsible for definition of the BNP Paribas group-wide responses to the new prudential regulations in close liaison with the regulatory experts in various business lines and functions. She's also in charge of orchestrating the group's relationship with regulatory authorities, industry associations, and relevant peers, leveraging various teams in the group public affairs, as well as the business lines, functions, and territories in a close liaison with the top management. She's also been appointed as an alternate chair of the AFME Prudential Regulatory Board since September 2015. She's a member of EBF Banking Supervisory Committee and actively participating to various industry groups and conferences. Veronique, I hope you can hear us well.
Hello, can you hear me?
Yes, sure. Welcome to the panel, Veronique. What I would like to ask you is, we've heard a lot about NPLs. We've talked about loan loss provisions that are impacting the banks, buffers, and banks' capitalizations. IFRS 9 is something that is connected to this. What are your main concerns when you hear about these topics?
Thank you very much for having me in this conference. I hope you can hear me and maybe even see me properly. I actually sit in the office because we are close to our people on the ground, and 90% of the BNP Paribas branches remained open to their clients during this crisis. So we felt that people in the senior management should also lead by example, and I'm now back in the office to kind of try and go back to normal. I'd like to start my remark maybe as a thought, and I agree with a lot of things that have been said since the beginning, even if they were, some of them, a little bit contradictory, because we live in a complex world where there are contradictions. My thought would be that actually a regulatory regime should be crisis-proof. So we should not fall into that trap that we need to change the regulatory regime after a crisis. The ideal regulatory regime, and of course that does not exist, but should be something that works well in good times and also works well, i.e. provides enough flexibility and is providing enough contracyclicality that it can also be maintained during crisis. Because it's not optimal to change it during the urgency. It's like you have to build the firefighter place at the time where you have a fire, and this is too late. So I think this is the first stage, test. I think, as Mario was saying before. of this package, the post global financial crisis package. In terms of the new crisis, we are learning from how it works. I have to say the regulators have been extremely prompt and determined. I think Mario said brave, and I think I can only agree with this word to try and implement as quickly as possible as the flexibility that was embedded in the system. But I thought that I would actually organize my talks around three horizons. The first one, which is the urgency, where we are currently, i.e., were there the right measure? Are those measures working? Why are they working? What is maybe less working? The second is, what is going to be the second step of this crisis? And what do we need to be prepared for? And that's where I will address the NPL, IFRS 9 and other issues that are still, I think, largely ahead of us. And then the third is I would say, the new normal. How do we get back to the recovery phase? And what can we learn, I would say, from a more permanent basis on about the regulatory regime and what may need to be adjusted based on what we learned during this crisis. So the first point in terms of the urgency step, the first step, and are the measures working? Clearly, there has been indeed a lot of measures. I think the banks are doing whatever they can to support the measures that have been put in place by the governments and by the European authorities to channel all the support as promptly as possible to the various client segments, households, corporates, in order to minimize the economic and social cost of the COVID crisis. This is undoubtedly our top one priority at BNP Paribas and in many, many banks. And of course, we are there to assist our clients, and that has been, our main focus in the last couple of months. Is this working? I think globally, it's fair to say that it is working. The ECB, it's a bit early, I guess, to have consolidated numbers in terms of how much lending has been put at work by the European banks. But if you look at the ECB statistics for the euro area in March 2020, the net flows of corporate loans in the euro area was up 125 billion euros, which is a huge number. It probably doesn't say much, but it is like 4 to 5 times the amount that was the average amount of the previous months since 2018-19, which were more in the region of 20 to 30 billion per month. So it's a huge jump in this number, and it's even double the reason where we were before the big deleveraging phase that took place after the 2008 crisis. In 2006-07, we were reaching around 50 billion euros per month, more or less. So here we are talking about 125 billions. And this is the month of March. We don't have more recent data. It's very likely that April will be even bigger because the measures have been put in place, obviously a little bit progressive, and April will be I think, a bigger month than March, probably May as well, and so on. So the banks are there. They are, open for business, if I may say. This is not to make a lot of money because, those loans are at cost basically for the banks, but we are there to support the economy. This is made possible, as Mario was saying, also because the banks are entering this crisis in a position of strength from a capital point of view. And I think despite this position, the magnitude of the credit needs will generate massive balance sheet inflation. And so the range of measures that the governments, regulators at international, European and national levels have been put in place are definitely warranted to minimize any negative consequence of the bank's solvency, because the last thing we want is to weaken the banks as the banks are supporting the economy and transfer the risk on the financial sector. So I think all this has been extremely intense and largely effective. The measures are clearly very welcome, but as there must be a but, otherwise we would not be there talking about it. I would like to make 4 points in terms of things that could be improved from the point of view of the urgent measures. The first one is regulatory uncertainty. The first move by the banks has been to allow corporates to postpone capital and interest payments to help them to cross the crisis without defaulting on their debt. Clearly, this is an absolutely major objective from an economic and social point of view. Those moratoria have been very early on declared by the Basel Committee as not needing automatic recognition as forbearance as long as the client was healthy before the crisis. This statement was extremely welcome. It came very early on in March. I don't have the exact date in mind. And it was extremely welcome. Now this is a BCBS statement. It needs to be converted into a European rule, and obviously in each of the jurisdictions. The EBA guidelines have introduced actually restrictions compared to the Basel Committee statement, in particular requiring that those moratoria should be general moratoria. So national banking associations have been working hard to develop as quickly as possible those national moratoria, which needed to be submitted to national authorities, and national authorities have submitted them to the EBA before providing approval. As we speak, and despite those massive moratoria that have been already put in place, we still do not know whether those moratoria will be approved or not, and therefore whether the IFRS 9 forbearance and the prudential definition of default might apply or not. I have to say this is a very uncomfortable situation. The banks are responsible, and therefore they will continue to support their clients. But this means that as we close our accounts in 1 month's time at the end of June, we do not know where we stand. The approval process is very opaque, very long, while our clients have obviously immediate needs that we have to respond. So the first point is regulatory uncertainty. The European framework is quite complex, and we recognize that, but definitely the technical implementation needs to be very closely monitored, because we need certainty. The second point is fragmentation. There has been a lot of discussion on fragmentation, I would say in general terms, based on the FSB report, the IIF report. We've been involved in all these discussions at BNP Paribas, and yes, there is a lot of fragmentation at the global level and within the European Union. I'd like to address fragmentation from the point of view of the COVID-19 responses. It's fair to say that given the European framework where it is now, actually the Commission has deferred to the national authorities the responsibility to design the response plans. Obviously, the health situation was different in each of the countries, the fiscal space was different, the economies are different, the needs were different. So the Commission at European level started by providing relief on state aids and fiscal rules, and send the ball, if I may say, to the governments for them to implement national measures. In particular, these state-guaranteed loans that have been put in place in most of the countries. However, those state-guaranteed loans are, as a result, different in each of the countries. Their framework is different, their technicalities is different, and therefore we are facing, as BNP Paribas operating in most of the EU markets, all sorts of different frameworks that we need to face and implement for our clients. The issue with this is that given the extreme rigidity of the regulation in terms of recognition of credit risk mitigation techniques, many of those state guarantees are likely not to be eligible to reduce the risk-weighted assets and hence the capital in some member states, whereas it may work in others. So that's a huge factor of fragmentation in terms of the crisis responses, because banks in some countries will be exempt from putting capital in front of those state guarantees. In other, due to very technical features that sometimes are not so easy to negotiate with the ministries of finance, because they tend to consider that their signature is worth something. But unfortunately, the CRR tells us that maybe in some cases it is worth nothing. So that factor of fragmentation is quite a problematic aspect. We understand that the Commission has mandated the EBA to produce some guidelines on state guarantees. We welcome that. We don't know exactly where it stands, but we would strongly recommend that such guidelines should be guided by the need to endorse a flexible interpretation of the CRR and ensure fair treatment of the public guarantees across the Union, as otherwise the purpose of those guarantees, which is to provide relief to the banks, would largely be missed, and that would fuel the fragmentation within the euro area. As you know, widening of spreads across countries is almost a lethal threat to the euro area itself, because it hits the transmission of monetary policy. So this is a very serious problem that hopefully the EBA can address in its upcoming guidelines, and of course in coordination with the Commission and the supervisory authorities. My third point is that we need a balance between multiple constraints. We've been focusing a lot in these discussions around the risk-based capital, but that's only one of the constraints that banks have to face. The post-2008 crisis regulatory agenda not only imposed constraints on the risk-based capital, including adding all those buffers that Mario described, but also imposed in Europe the leverage ratio, imposed TLAC and MREL, systemic scoring, and so on and so forth. Those are all different dimensions that are putting constraints on how much a bank can lend to the economy. The problem I have with the numbers that Mario has very eloquently described, so the 600 to 1.3 trillion, let's even take the 1.3 trillion. I think ECB was coming even with a 1.5 trillion at some point. I don't know what is the right number. It's a huge amount of lending potential that has been provided to the banks through the relief of a number of buffers and some other measures. That's great. But banks will only be able to put that money on the table at work with clients if the other dimensions of the constraints are also addressed. And at this point, nothing has been made on the leverage ratio, on the leverage exposure, I should say, because arguably the leverage ratio is still only a reporting requirement in Europe, but still it is, first of all, it is looked by the market very closely. And second, the leverage exposure itself is an input to the TLAC number, for example, and to quite a number of other regulatory metrics. So on the leverage, if we get relief on the risk-based capital side, and we don't get relief on the leverage exposure side, at some point the leverage exposure becomes the binding constraint, and will prevent the banks to put at work all this quantity of lending that was relieved from the risk-based standpoint. Same thing for the MREL. If the relief in capital translates into a need for actually increasing the emission of bail-inable debt because the MREL target has not been revised commensurately with the capital target, then clearly a lot of banks will find difficulties to issue this debt in the market, and therefore their main constraint may become MREL, which, as you know, applies to all banks in Europe, whereas the TLAC only applies to the GSIBs per the FSB framework. Same thing for the systemic scoring, which applies to the GSIB, but also to the domestic CFIs. So I heard with interest the points that Martina made earlier, that we should promote the expansion of cooperative banks with granular and very local structures. Of course, as BNP Paribas, we are a different kind of animal, and we have the weakness to think that we may be useful in the ecosystem of the banking sector in the economy. So the systemic banks, I think, GSIB and DSIB combined represent probably 70% of the bank financing in Europe. So that's also a very important constraint. So so my point is, we need a balance between the relief provided in the various directions, in the various constraints. Otherwise, the full amount of the potentiality of the measures will not materialize. And so while some observers have considered that enough had been made to help the banks help their customers, actually we should not add other measures on leverage, for example, to what has been done already. It's just next to them. It's like a safe, where you have two keys to open it. You may have one key, which is the risk-based capital. So you open it, that's fine, but still the safe does not open. You need the two keys, and the second one is the leverage exposure key. If you don't have the two keys at the same time, then the door is not going to open. My fourth point is about buffer usability. I think Mario also touched on that, and I think it's a very fundamental part. A large part of the relief has been provided through a very useful clarification that capital buffers are usable to absorb losses. This was a feature that was very clear in the Basel framework, but it was, I would say, not totally explicit, and this is an understatement, in the European transposition. And I must say that when I see the EBA still talking about overall capital requirements, including some buffers, I still think that the semantics are not quite well aligned yet. So we have a requirement. In the US, it is very clear that the requirement is the 4.5% minimum requirement, Pillar 1 minimum requirement. Everything else is a buffer that can be used in times of losses. But anyway, the statements have been a huge step in the right direction, and this is very welcome. However, it happens that banks are quite reluctant to use this flexibility, despite the encouragement, notably by the ECB. I think this is due to the stigma that is linked to the possibility to publish ratios below the combined buffer requirement, which continue to be called requirement, and of course the MDA mechanism that would prevent banks to pay AT1 coupons if they breach the trigger. On the other hand, we see that actually the MDA is not even working as it should, to the extent that even for banks, like most banks that have still a wide distance to MDA, supervisors have requested to suspend dividends. So the suspension of dividends is something that is in the regulation supposed to be triggered by the MDA, but even if you are 200 basis points, 300 basis points above your MDA, you are currently in a position where you cannot pay dividends. So I think this MDA framework is being tested for the first time in this crisis, and probably needs some further thought to ensure that the desired flexibility can really be put at work for the benefit of the economy. So that would say my kind of immediate lessons from the urgency measures that have been taken. If we move on and consider that the urgency has been dealt with, most of it, then we still have the quick fix of the Commission, but it's ongoing. And when we move to the second phase, what is ahead of us? And frankly, the measures that have been taken so far, we are not permanent relief, of course, and are not solving the situations. They are helping the economy to gain time. So the clients have time, 6 months, 12 months to repay their loans. It's great. It was absolutely necessary, but we have only gained time. So we are starting to project ourselves in 6 to 12 months at the end of this first wave of moratoria and state-guaranteed loans. The first point is that a proportion of those companies that have benefited from the first wage message will not be able to reimburse. This is unfortunate, but this is extremely likely. The cash flows in many companies and many sectors will not be back to pre-crisis level. Some sectors will maybe still be in partial lockdown or with very low level of activities. There will be changes in behaviors by the clients, changes in the supply chains, and so on and so forth. So a lot of disruption in the real economy will take place in the next 6 to 12 months. And I think we cannot hope that we are going to come back to normal. This means that, first of all, the loans that are being put on the books of the banks today will be there for some time. They will not be there for 6 to 12 months. They will be there for some time because, of course, at the end of the moratoria, the banks will convert some of those loans into longer-term loans, maybe 5, 6 years, which means that the impact on the financial structure, the impact on the balance sheets of the banks will last for quite some time, and therefore the flexibility will need to be extended for that time. Of course, banks can only convert the loans into longer-term loans to the extent that the company has a sustainable level of debt. That will be the case, hopefully, for a large part of the companies, thanks to also all the fiscal measures that have been done. But not all companies will be able to show a strong enough balance sheet that the banks can be comfortable to lend at 5, 6 years to this company. Therefore, the second point is that we will need significant equity or quasi-equity injections. This may be blended finance with some support by national authorities, European authorities like the EIF, and of course, private capital. This is a theme of so-called re-equitization of the economy. As much as the banks entered the crisis with a position of strength, it's fair to say that the corporates have entered this crisis in a position of already high leverage. And of course, things are getting worse as the crisis is denting their cash flows. Sorry. If there is no viable solution, neither for longer-term loans or equity, the last resource option will be default, and therefore there will be obviously an increase in NPLs that is going to show up in the coming quarters. How do we handle this second phase in this situation? So clearly, equity, quasi-equity injections are very important, and I think there is a start at the European level of discussion on that in the context of the CMU. The role of development banks is essential. The role of institutional investors such as insurance companies is essential. Insurance companies have been discouraged by Solvency II to invest in equity. This needs to be revisited. And then there's a key question about what would be the role of the banks. Typically, the banks are there to provide debt more than equity, but do we need to change this pattern? Because the banks, especially when it comes to SMEs, may be closer to their clients and therefore better placed. And the second point is revisiting the NPL action plan. The NPL action plan has been designed in a totally different context where the purpose was to reduce as quickly as possible the NPL ratios at the banks. This is not realistic in the post-COVID world. Targeting an NPL ratio below 5% as a kind of one-size-fits-all measure was already meaningless, I would have argued before, but is now totally meaningless. The incentive to sell NPLs in the secondary market should be removed. We don't want an aggressive workout framework. We want a responsible, socially responsible workout process. It's not a US private equity firm. I'm sorry for them. They are doing a great job, but they are not the best place to handle the workout for SME companies in Europe. So we need to be very, very careful to change soon enough the set of incentives that have been put in place in the NPL action plan, because what we need is a European approach, a kind of social marked approach that reconciles the requirements of the financial world, but also the social and economic goals of job protections and household protection. What would be at this stage for the longer term, and I will finish on this, what are the lessons to be learned on the regulatory side? I already mentioned the buffer usability. How can we improve the MDA framework? Should we include a hierarchy between AT1s and dividends payments? Should we have less buffers that are under the MDA? Because currently only the P2G and the countercyclical buffer are outside of the MDA. This means that the flexibility is obviously very limited. Should we have less capital conservation buffer and more countercyclical buffers so that the supervisors have the possibility to play with the level of the capital requirement in a much with more amplitude? What is the interaction with stress tests? This was already a big discussion in Europe with the EBA work on the 2022 new design. Are there lessons to be learned from the COVID crisis as relates to the stress test design and stress test implementation in the capital framework? All these issues, I think, should be dealt with in the TRD6. It's obviously not as urgent as what I said before, but I think this is a topic that needs to be addressed at the European level, but also, of course, at the global level, because those are aspects on which there is absolutely no degree at all of level playing field between various players, various jurisdictions. The second lesson is the pro-cyclicality. We have seen in this crisis a number of regulations that are definitely too pro-cyclical. IFRS 9 is one. Prudential valuation in the market risk framework is another one. in the new regulation that is not yet implemented, I'm thinking about FRTB. We've said since the early discussions on that FRTB would be extremely pro-cyclical, especially with the P&L attribution test that would disqualify internal models if the backtesting exercises show differences. I think that the FRTB, if it had been in place during this crisis and given the amplitude of the market movements that we saw in February and March, would have disqualified all the internal models of banks, and the impact on capital would have been totally unmanageable. How do we address more broadly the backtesting of models? Should we recalibrate all our default probabilities and LGDs and market risk parameters based on the COVID-related observations, or should we exclude them? These questions are quite important to be dealt with in the medium term. And finally, the lack of flexibility, which is slightly different from pro-cyclicality. I mentioned credit risk mitigation. I think the credit risk mitigation prescriptions in the current CRR and in the new Basel IV framework are just too tight. If they cannot even manage state guarantees, how can they manage parent guarantees or physical collateral? They don't. So that is definitely something that is very problematic from a risk sensitivity standpoint, and we should reopen that. The second point is, do we have too much in the level 1 text? The only thing that we have left on the table today is a quick fix of the CRR by the Commission. It's also very brave, I would borrow this word again, for the Commission to have launched this process. The Council and the Parliament are working extremely hard, but frankly, we should not be in a position to change the law just to get a little bit more flexibility on a VaR multiplier hidden somewhere in the market risk framework. This should be under the responsibility of the regulatory authorities and the supervisors. So maybe we need to learn also from that and empower more the regulatory authorities, because the text cannot be so prescriptive, and we need more trust in the authorities. So with this, of course, I will be very open to answer any question at the end of the panel if we have time. Thank you very much.
Thank you very much for your inputs. I think you raised some very important points, and it's important for us to hear from such a large bank and the insight that you have from the front lines. Before we move on, I would like to give Mario another 1 minute. He expressed his wish to counter, I guess, something that was said, whether in your or on the previous panel. So Mario, just 1 minute, please be quick. We need to move on.
Just 1 minute, and actually is just on a point which is dear to me and on which I agree with Veronique, and I don't want to be misunderstood on the overall capital requirement. It is true our analysis is analyzing the loss absorbing capacity above the overall capital requirement, because we say this is the stuff that doesn't affect anything. But this is not to say that banks cannot use the buffers, let's say, triggering the MDA. So this should be crystal clear. And actually, if you look at the Pillar 2 capital requirement and the Pillar 1 capital requirement, there are additional 400 basis points of buffers that can be used, including the capital conservation buffer. So on this, I completely agree, and I don't want to be misunderstood. Thank you.
Thank you, Mario. Clear. Thank you, Mario. All clear. Moving on, we have our next panelist. We're very happy to have Ms. Onag MacDonald, who is an international expert in financial regulation. She's a former board member of the UK Financial Services Authority and Gibraltar Financial Services Commission, board member of a number of commercial financial companies, including International Board of SCADIA advised financial regulatory authorities in Indonesia, Sri Lanka, Brunei, Russia, and most recently in Ukraine and Moldova. Provided strategic consultancy to financial firms, author of numerous articles and books, most recent ones, Fannie Mae and Freddie Mac, Turning an American Dream into a Nightmare, Lehman Brothers, A Crisis of Value and Holding Bankers to Account. And I know she's now working on a piece of work looking into LIBOR, but I'll let her discuss issues. What I would like to know is, we see that bank internal models produce different results. We've just heard that from different people coming on the floor. What is your take on the transparency and the limits of such models and their track record in the current environment?
I wanted, first of all, to say, I wanted to look back at some of the models that were used, or briefly refer to the models that were used in the run-up to the last financial crisis. And I think one of the things I want to say about Basel III, and some of the previous mentioned this too, it is a good thing that the governor of the Federal Reserve Bank and the chairman of the Federal Reserve Bank and the governor of the Bank of England, and of course has been said about European banks, that they are in a much better position to deal with this particular crisis than they would have been at an earlier stage. So all the capital requirements that Basel has put in place, I think I hope that we will be able to, we will acknowledge the benefits of all that work that has been done, has finally culminated in the 27 agreement. Certainly that is an important step forward. Whether or not these scenario tests, which have been carried out to on the banks, the stress tests, are extreme enough, or took such extreme conditions into account as COVID-19, which has resulted in the shutdown of so much of the economy of each of the countries that we have been talking about. In America, that is particularly hard. Contrary to one's picture of America, about half the employment in the private sector is small businesses. The analysis of small businesses in the US shows that 30% strong position, 30% break even, and 30% actually make a loss. So how many of those small businesses will actually survive the shutdown and be able to provide employment for others is very difficult to determine at the moment, except unemployment now stands at 39 million, which is a horrific figure. And those are people who've applied for unemployment benefit, not those who are currently furloughed. And of course, how long the post-furlough situation will last so that those people can continue in employment is hard to tell. Let's just remind ourselves about the internal models, complex and opaque in the run-up to the last financial crisis. A bank's reported capital ratios could vary by 50% for the same hypothetical portfolio. Oversimplistic models were adopted by the rating agencies, so that, of course, meant that the mortgage-backed securities were frequently rated as AAA, when in fact they contained a large measure of subprime mortgages. What is not perhaps understood is that banks were obliged to sell an ever-increasing amount of subprime mortgages to Fannie and Freddie. By the time we reach August 2008, 50% of outstanding mortgages in the US were subprime mortgages. So a huge baggage unaccounted for in terms of capital requirements and in terms of a proper estimate of their risks. And of course, those mortgage-backed securities were sold throughout the world. And others bought them unknowingly, believing that they were triple rated. Fannie and Freddie bonds were actually had to be ultimately guaranteed by the American government, although strictly speaking in terms of the legislation covering Fannie and Freddie's sale of their bonds, they were not supposed to be. So the financial crisis and the continuing work of Basel III in building up the capital available is, I think, extremely important. And I think whatever problems, the way in which the capital required is calculated, whatever difficulties have been fully expressed here today in the leverage ratio and possible lack of flexibility there, I think that in the end, looking back, banks may be thankful that they were able to start in a stronger position. A couple of other points before I move on to what I want to say about models is this, that non-performing loans have been mentioned. I think that residential mortgages, we are going to see a large number of losses and foreclosures in residential mortgages in the US, because I really don't see how those mortgages are going to be maintained as a result of the total lockdown of the economy, and it's only slowly being unlocked. The northeastern states are only slowly unlocking the measures that were taken as a result of COVID-19. What do I think is important about the models? Well, the most important step forward, I think, is that where banks are allowed to use their internal models, that there are different levels, demanding levels, in terms of requirements of the assessment of those models. Banks are now required to have a separate function to oversee the models, to test the models, to evaluate the models, both examining the developed model, examining the way in which the model is actually implemented, and looking at the various models that are used and how they are brought together. Secondly, I think it's extremely important that the regulators are obliged to assess the models that are used. And thirdly, another additional point is that independent reviews are conducted by academics and other experts in the field are important as well as a third and a reference point that is absolutely outside the regulatory provision and outside the bank's internal models. All of those seem to me to be very important, and I will just give an example. I've already given an example of the ways in which those models were not tested, were not evaluated. No, they were approved by a board, but the board was not given the content of the models and explanation as to how those worked and so forth. Just a side example to that, if we look at some of the models that have been used in the COVID-19 crisis, and we found that one of those models in particular gave alarming outcomes of COVID-19, suggesting 2.2 million deaths in the UK and 500,000 deaths in the US. 2.2 million deaths in the US, 500,000 deaths in the UK, and the person who produced that model, which has actually led to the lockdowns, not just in the UK and in the US, but throughout Europe, will not even share the assumptions of the model with anyone else. So that used to be the case for banks' internal models. It is no longer the case for banks' internal models. And I think that those are extremely important steps being taken forward. Of course, I am quite sure that banks look at the documentation requirements for every aspect of the model, why that particular model was adopted, how it was attested by the independent group, how it related to other models that the banks use, because banks use a large number of models. The documentation requirements are no doubt time and effort involved in that as something that banks really do not like. On the other hand, my answer to that is to say, if you want a well-run bank, then such documentation, such understanding of what you are actually doing and the risks that you are taking on is extremely important. Your bank will suffer at some point if you don't have those documentation requirements. My last point in this is operational risks, of which, as you know, cover internal processes, people, systems, or external events. It includes legal risk. That's the definition of operational risk. This is now calculated according to the losses in various categories that the banks have sustained for over 10 years. In other words, it is a backward-looking estimate. I think that trying to find a particular calculations for operational risks is extremely difficult, especially if you only look at losses. Two quick examples of that. As you said, my holding bankers to account covered LIBOR manipulation. Easy for banks to look at the outcome of LIBOR manipulation favorably, because it actually appeared to mean that certain trading desks were profitable. And so you wouldn't be recording a loss there. Instead, you would be recording a profit until, of course, the denouement happens and you discover what was going wrong with your trading desk and with the submissions that you were taking to the benchmark LIBOR. Another more recent example in the US is Wells Fargo. Again, apparently profitable. This relates to a period in which bank cashiers, pretty much on minimum wages, were able to open up apparently a large number of retail accounts. Again, apparently bringing profit to the banks. These were, of course, false and sometimes fraudulent accounts, in that by setting the reference to a new false bank account to 0, you were able actually, as a person responsible for such accounts, to move money from that account into your own account. So clients actually suffered losses from such fraudulent activities. There again, the operational risk calculations would not have shown losses, but would have shown gains until, of course, the frauds were discovered, in which case you would certainly have discovered losses running into $3 billion in that particular case. So I would argue that operational risk is a matter for supervision. And as far as the banks are concerned, yes, of course, you would have to take losses into certain areas into account, but that would really be a matter of business enterprise management. Operational risks covers the behaviors of people in various aspects of the bank's activities, and it is very difficult to know what people are actually getting up to. And that is where I think that all your employees I refer to here, of course, there's some time before that can come to light, except if you then move to what the UK has particularly introduced and strengthened, and that is senior management responsibility and all the procedures that flow from that. So I would say, yeah, operational risk, not properly calculated. Operational risk really means that supervisors have to look at the conduct of the whole operation of the bank and make sure that senior managers are actually know what is going on, have proper information systems, have red flag warnings and so forth, so that they know what is going on in every aspect of the bank, and that is a proper approach to operational risk. Now, of course, in our present environment, the bank's internal risk models come to the fore, not just in the kind of lending that the banks are being obliged to undertake by their central banks in order to sustain the economy through the closure of so many aspects of the economy, but the banks will have to look forward and understand what they are going to do with the non-performing loans that are going to emerge from this crisis. Postponement, as your previous speaker said, is not enough. Flexibility from supervisors in the future, I understand, will have to be taken, but if they can rely to a much greater extent on the bank's own internal models of the impact of the crisis and the capital that's going to be required to sustain those banks in the future, then that is an enormous step forward compared with the run-up to the financial crisis.
Right. Thank you. Thank you so much for your time and inputs. We are quickly moving on to our next panelist. We are most likely stepping into the next panel, which we're going to try to limit that to a maximum extent. We have Mr. Tommy de Timmerman, who is the Policy Officer, Bank Regulation and Supervision at the European Commission. So we have a European Commission representative. He's previously Bank Recovery and Resolution Expert, the Single Resolution Board. Prior to this, he held various positions in the banking world. He also teaches at the European Financial Integration and Banking Regulation and the Solvay Business School of Management, Economics and Management. Mr. Timmerman, welcome to the panel. What do you think, or can you share with us, what is the European Commission response to the whole COVID situation and the implementation of the Basel III standard?
Thank you. Can you see me and hear me? Good. So until the month of March, I think I was working full time on the implementation of the final Basel III agreement in the European Union, and the aim at that point was to have a Commission proposal for this implementation by the month of June. So obviously that has changed with COVID, and so I will just try to explain briefly what was our approach to and our calendar to Basel implementation, how that has changed with the COVID, and what is it that we're doing now to respond immediately to the COVID crisis on the banking regulation front. I think our approach to the implementation of the final Basel standards in the EU, and our starting point has always been the international agreement. I think I heard different approaches from the different panelists. For us, clearly there's a value in this agreement, both on content, because I think there is a need to restore confidence in internal models. It's something as regulators and supervisors, Europeans argued at the Basel Committee for the continued use of internal models, even though there were some issues with those models that had been highlighted, such as excessive variability of outcomes. Other parts of the world were not so keen on that. So I think the agreement that we have and the compromise that we have reached is that to a large extent we can continue to use those models, but we have to make sure that they are consistent and that they are reliable. I think the exercises, the TRIM exercises that have been mentioned, and also the work of the EBA on the topic have been very helpful, but we still see a level 1 measure as in the Basel Agreement as a useful complement to that. I think also in terms of commitment to a multilateral approach and to international cooperation, this agreement is very important. I think, yes, I hear the fact that you have different market structures and you don't have to impose exactly uniform rules on different jurisdictions, but the fact of having common rule, I think it's a very big advantage for everyone, and first and foremost for international banks that have to that are operating in several jurisdictions. So on content, and also as an example of our commitment to international regulatory cooperation, we have to implement that agreement faithfully. Of course, there's other elements that we have to take into account when we're doing that in the EU. We have to take into account the specificities of the EU banking sector, which is different from other banking sectors and economies that are more financed via capital markets sometimes. And we have to take into account the fact that the EU banking sector is very diverse, and we have to preserve that diversity when we think about the rules that we want to implement. And there is that commitment to no significant decrease in capital requirements overall, which has made at international level, but is also a commitment that has been made by the European co-legislators, the Council and the Parliament. So in the Commission, in preparing the proposal, we have to square the circle. It's not an easy exercise, but I think it's feasible, and so we're working towards that. We were at the point in end of February, beginning of March, of finalizing our impact assessment of the proposal that was going to come out. So we also have an impact assessment. I mean, there's been a lot of impact assessments by different stakeholders. So we were finalizing ours. Obviously, that has been put on hold for the moment, and so when we take up that work, we will also have to take into account the changes that the COVID crisis has brought to the financial situation of the financial sector and the economy as a whole. So the Basel Committee itself decided to give one more year to implement the agreement. That's very welcome. So we have to see how do we work that out in the EU. Obviously, we're not going to propose anything in June. Whether it will be later on this year or I don't know yet, but we will postpone, and we have to see when we were able to come up with that proposal. In terms of what we did for when COVID struck, so I think we tried to very quickly move to a crisis response and see what we could do. I think, as has been said, the starting point is very different from what we've seen in the global financial crisis. There is the economy has been hit very hard, but the banks are in a much better situation than they were before, and that also thanks in great part to the regulation that has been put in place so far. So banks can be a part of the solution this time, and they are being part of the solution. They can help in extending credit, continue to lend to the most affected clients. I think the public authorities and not only regulators have taken very decisive and swift measures to make sure that banks are in the conditions that they need to be able to channel public help. I think there's been an extraordinary monetary policy response, also on the supervisory side, all the measures that Mario described earlier. And on the Commission side, I think one of the first things we did beyond my remit is to exploit the full flexibility of the fiscal rules and the state aid rules, so that member states could put very decisive measures in place as well, such as guarantees and payment deferral schemes. So I hear the fact that these are national measures. I think after that, there's been a lot of coordination at the European level. the crisis fighting measures announced by the Eurogroup, or I also encourage you to look at what will happen tomorrow, and we will have a European Commission announcement on the recovery phase. So what we have done in terms of banking regulation was to make sure that we had the regulation in place, we had the conditions for those measures to be effective. We've worked with supervisors to make sure that we explain and clarify the flexibility that is in the rules, because there is quite a lot of flexibility in the rules that we can already exploit, notably the accounting rules and the prudential rules in terms of NPL classification. So there have been various statements by supervisors. We as Commission, what we have done is that we have issued an interpretative communication of prudential and accounting rules to confirm what supervisors have announced and highlighting that flexibility. And on the other hand, also inviting banks to use these resources that have been freed up and use that flexibility that has been made available to continue financing their clients, adopting a prudent approach, and so not to distribute dividends or be conservative with a variable remuneration for the time being. I think we went a step further, and we have put forward a proposal for targeted and temporary amendments to the framework, so that we're sure that we have all the elements that we need in this phase of the crisis. That is something that comes in addition to the existing flexibility, but it's something that we wanted to be uncontroversial and very targeted, to make sure that it's something that we can also push through the legislative cycle in a very short period of time, to be applicable when it is needed. So our aim with this is to have this proposal adopted before the end of June, so that it is in place for banks before the next reporting date. What do we have in there? Again, on the accounting rules, what we have is an extension for banks of the transitional period during which they can add back capital that results from would result from the application of IFRS 9. So that is something that was in place already that we're extending. We also have an extension for COVID-related guarantees of a favorable treatment that was already applicable to export credit agencies in what we call the NPL prudential backstop. So these mandatory coverage requirements for NPLs that have been put in place in recent years. We have measures on the leverage ratio as well, because as was mentioned before, so you have risk-based requirements on the one hand and leverage ratio on the other hand. One thing that we have done, also following the international rules on that side, is to postpone the implementation of the leverage ratio buffer for GSIBs. And we have also eased the rules for offsetting an exclusion in the leverage ratio for central bank reserves, because in times of crisis, that would have monetary policy, and otherwise you could have negative consequences of the fact that the central bank reserves that banks hold would grow rapidly in those times. Finally, what we've done also is to put forward the applications of measures that were already agreed upon, that would bring capital release that banks can use to lend. So in the previous banking package that we implemented in 2019, we had a series of rules to stimulate lending to SMEs for infrastructure projects and also investment in software by banks. They were due to apply next year, but what we're proposing is simply to apply them immediately as soon as this legislation will pass. So, so we hope that we can finish the negotiations by the end of June on this, and that we can have these temporary and targeted measures in place to face the exceptional circumstances in which we are. But all of this is only temporary and targeted. And just to be clear, that we're after that we will resume our work on the Basel implementation, and that we remain committed to finalize the post-crisis framework. Thanks.
Thank you very much. We're very much looking forward to hear what you will have to tell us tomorrow, as you've announced. So thank you also for addressing some of the questions that some of the panelists have raised during this panel. I think that's more clear now to all of us. So thank you for your inputs. I'll be bringing on to the stage now Mr. Christian Steffmüller, who is the Senior Advisor, Research and Advocacy from Finance Watch. His principal research interest at Finance Watch on the financial stability, in particular prudential regulation, resolution, and financial safety nets. He also regularly works as an expert within international organizations such as the World Bank and the IMF. He holds a graduate degree in law and applied languages from the University of Innsbruck and a master's degree in business administration from University of California at Berkeley. Mr. Steffmüller, it's good to have you on the panel. I've seen a report from Finance Watch and or actually some disclosure that were quite shocking to me. I'll just list some of them here kind of to provoke the discussion. You state there that it's estimated that there is about 1 trillion euros of bad loans in EU, which is about 3% of the assets. But US banks were fined with 179 billion, whereas the EU banks only 20 billion by regulators. So there are 1,700 lobbyists currently employed by financial institutions to influence the EU policy making, and that 4,500 bankers have earned more than 1 million euros only in 2016. So on January 3rd, 2020, Finance Watch submitted its response to a public consultation held by the European Commission on the implementation of the Basel III reforms in EU. What were your key proposals?
Well, first of all, thank you very much for inviting me on this very distinguished panel. I would quite like to start by reminding our participants of the overall statement of Finance Watch is here. Finance Watch is a non-profit, non-governmental organization. Our purpose is to make finance fair society. That is basically our point of departure and also in respect of topics. Effectively,
I'm sorry, excuse me. We have a little bit of difficulty hearing you. I don't know whether your microphone is close enough.
Right.
So if you can just try to adjust a little bit closer. Yeah, let's try with that.
Can you hear me all right?
Yeah, it should be better now.
Marvelous. Thank you. So essentially, just to reprising, the point of departure is our motto, which is making finance fair society. And this informs very much sort of our take on the topics that you have just mentioned. What I would quite like to do today is briefly, rather than sort of going into each of the individual points that you have raised, which come from different publications that Finance Watch has circulated in this. I would quite
I'm sorry, we still have a little bit of the difficulty. I think every third or fourth word is heard. I don't know if you can just try to hold the microphone a little bit closer.
Can you hear me now? Is that better?
Yeah, sounds better now. Thank you.
We essentially, for us, the point of departure is 10 years ago when Europe was effectively confronted with its biggest political and economic crisis. The double impact of the global financial crisis of 2008 and the sovereign debt crisis of the Eurozone in 2010. Now, as we all know, Europe has mastered these twin crises, but at a huge collective cost. rescuing the banking sector did not only cost trillions of euros, it cost, in terms of political capital, was even higher. The loss of trust in government and institutions, which has emboldened anti-European, anti-democratic forces at both extremes of the spectrum. Now, we expect from regulators a response, and that response has come partly through the Basel III process. A major effort has been made to rebuild trust, stabilization of the banking system, and removing the unspoken public guarantee for private sector banks and other systemically important institutions has been the central promise of the Basel project. Now that we're faced with another crisis, the public will watch with some concern what becomes of these commitments. Reviewing the Basel III commitment and reviewing the Basel III process as it currently stands. We appreciate that progress has been made, but we would also, and this has been the nub of our submission to the Commission and our publications, could also maintain that Basel III has not conclusively solved the underlying problems in financial regulation in general, and in bank capital requirements. I'll give you sort of 4 points here. First, we have spoken quite extensively today about modeling and the complexity of capital requirements models. In particular, also, an earlier speaker has pointed out the IRB approach and all the complexities come with it. IRB is difficult and expensive to supervise. It is a challenge to supervisors, but it is also a material cost to the public. Some of that we can see, for instance, by the very comprehensive exercise currently performed by the ECB, an exercise. Secondly, there's a lack of transparency by virtue of the complexity of the IRB. Transfer information asymmetries exist, but under the pricing of risk for investors are more difficult and push up the cost of capital as a result. That was mentioned by the Thirdly, there are incentives to game the system. The variations in the calculation of RWAs have been demonstrated and commented on time and time again. And we can really sort of not put it any better than the words of Andy Haldane, former chief economist of the Bank of England. He basically put it as tackling complex banking through complex regulation is to fight fire with fire. Unlikely to work in theory, and experience suggests it has not worked in practice. Second point that the issue we have with Basel III is the parallelism of regulatory frameworks, the coexistence of a standardized approach, an FIRB approach, an AIRB approach, all together conspiring to unlevel the playing field. The built-in incentives to use IRB place smaller banks, which are part and parcel of the European banking landscape, important for its resilience and vertical structural disadvantage. The output law that's been criticized by an earlier speaker has been introduced precisely in recognition of that issue. Next point, the overall level of capital are still considered insufficient by us and by many other observers. Whenever we hear about the progress achieved with Basel III, it is with reference to what came before, which was patently not enough to prevent the global crisis in 2008. Basel III capital requirements are informed by a minimalist view of what would have been sufficient to survive the crisis of the past, but not what may be necessary to tackle the crisis of the future. There is perhaps sort of a nutshell to put it in. Regulators sealed the deal to triple the size of capital reserves It sounds tough, but only if one fails to realize that tripling almost nothing doesn't really give you very much. For all the talk about capital ratios of 15% that we've heard of several times today, the bottom line for most European banks is still the unweighted leverage ratio of 3%. That was just mentioned by, I think, BNP Paribas, which is not much different, in fact, from what the major US banks had going into the 2008 crisis. And fourth, Basel III, in our view, and this is one of the very, very big bones of contention from Finance Watch's perspective, has not solved the too big to fail problem. Systemically important institutions continue to benefit from implicit and explicit public support. Capital buffer requirements for SIDS in Basel III are widely seen as insufficient. Martin Wolf, the FT journalist, put it very succinctly: this amount of equity is far below levels that markets would impose if investors did not continue to expect governments to bail out creditors in crisis. Experience with the recovery and resolution regime, another supporting feature of the Basel Code, shows so far that, if anything, policymakers and regulators lack confidence, and SIDS, for the most part, are still considered to be okay. So all in all, our view, and this informed our consultation responses to the Commission, to the Basel Committee and others, Basel III still fails in what post-crisis regulation originally set out to do, which is to address the inherent flaws of Basel II, that gave banks economic incentives to focus their energies on optimizing capital requirements rather than the quality and returns of their assets, and to reduce systemic risk by removing the implicit public guarantee for systemically important institutions and create a framework where bank management and investors, not the public, bear the cost of financial distress. But for all the shortcomings, Basel III, with its higher capital thresholds, output floors, leverage ratio, is an improvement over its predecessors. And that brings me to some of the criticism that has been leveled against it by the banking sector, including by other members of the panel today. We've heard earlier on a critique that was centered largely on the implementation of the final tranche of Basel, based on a model that hinges on a central tenet that higher capital requirements reduces bank funding. Only that this outcome is a premise that had been baked into the model. To understand the findings and to have a critical view of the findings, I think it's quite important to point out that this approach is a bit at odds with standard financial theory, in particular Modigliani-Miller, which posits that all other things being equal, the choice of equity and debt financing does not affect investment, meaning that, in theory, the level of capitalization did not have a direct impact on the investment choices, on the credit policy. Interestingly, that paper goes on to reject Modigliani-Miller on the grounds that debt funding is objectively more economical for banks because it benefits from explicit and implicit guarantees. The existence of these public subsidies in the post-crisis Basel III world is something contentious. So this observation is, of course, very important. Only that it doesn't refute Modigliani-Miller. It simply proves our long-standing point that the regulatory effort so far has been less than finished. First by that. Secondly, the argument goes on to say that Basel III doesn't ensure a level playing field, and that EU banks' capital requirements would go up by an estimated 24%, whereas the average capital requirements for European banks would go up by 20%, whereas the equivalent average capital requirements for US banks would remain almost unchanged.
it's been said there is no evidence that there is a need for a substantial increase in risk rates for European banks with these internal models. But from our point of view, without that, consistency of our IRB risk rates, as I mentioned earlier, is an issue. For instance, the first set of findings from the ECB's TRIMS exercise, published in April last year, has found that on every single point of inquiry, between 2/3 and 3/4 of the sample had deficiencies. 20 to 25% of those were. The unlevel playing field argument that's been put forward reflects the concern of a comparatively small group of big European banks who find themselves in direct competition with a similarly small group of US and other global players. The argument does ignore Collins' amendment to the Dodd-Frank Act, which in fact submits US banks to a 100% output floor. With US banks starting from an output floor of 100%, it's not surprising that the impact of Basel III output floor on European banks, 7.5%, is rather more pronounced for the European banks. Finally, on that point, from the point of view of the remaining 6,000 banks in the EU, the level playing field issue is much closer to home. It is that banks that use the standardized approach, as I mentioned earlier, face a built-in disadvantage vis-a-vis other European competitors that apply the IRB. So when we talk about, as we have done extensively in recent regulatory discussions about CR2 and CRD5, about proportionality. Proportionality substantially starts right here. There is also a point, the point that the framework, as has been said by one of the previous speakers, Basel III framework brings fewer benefits than costs for the and has a net detrimental effect on households and businesses. We've looked at the argument, and from our point of view, conclusions that are based on a Basel Committee study from 2010 considers in particular at what level a system-wide average level of capitalization increases the risk of a banking crisis. But here it's quite important to distinguish cause and effect. From a public interest point of view, which is our point of view, it is irrelevant whether the crisis is triggered by the banking sector or whether it is exogenous. So whether it's endogenous or exogenous, the fact that the likelihood of the crisis is being triggered by the banking sector is a necessary condition, but it's not sufficient. The legislative mandate is to ensure that the banking sector is capable of absorbing a crisis without having to recourse to public funds.
Mr. Stansmiller, sorry for interrupting you. We still have a little bit of a difficulty hearing you. If you don't mind, since we're very short with time, I think we got the major points. Let me bring in our last but not the least panelist, and if in case the time allows, we'll bring you back in for a couple of more closing points. It's very difficult to hear you, so just for the sake of the viewers to be able to see whether it will work better with the other panelists. So let me bring in.
I would quite like to round off the.
No problem. So just try to look at the microphone, and while we're talking to the next panelist, and we'll come back to you in a minute.
Hi, okay. Good afternoon. Can you hear me?
So we have, yes, Mayra, we can hear you well. So Mayra Rodriguez Valadares is the managing partner at the MRV Associates New York. She is a Basel III, Dodd-Frank, and capital markets consultant and a trainer. She began her career at Fed New York, where she was a foreign exchange analyst. Subsequently, she was a junior investment banker and later an emerging market fixed income and equity strategist with JP Morgan, New York, and London. Published numerous articles and books, graduated from Harvard at Radcliffe College with AB in Russian and Soviet Studies, graduated from the Wharton School and the Laudier Institute of the University of Pennsylvania with an MBA in Emerging Markets and Business and an MA in International Studies. I hope I haven't forgotten something. Next slide there is, how has deregulation impacted the international banking regulation and agreements? And I'll ask the same question that I asked some of the previous panelists. Should the regulators be asking for more or less from the banks?
Yes, we definitely are living in very, very interesting times. Thank you very much for inviting me, and I certainly have very much enjoyed and learned a lot from my fellow co-panelists. So my comments very briefly today are based more on issues of implementation and supervision, because my panelists were very good at explaining some of the details in terms of changes in Basel III and IV, and I know that I'm the only thing that stands between dinner and maybe the pub and you. My comments are, I would say, in 5 themes, if you will, about challenges in implementing Basel III. First, I see that unfortunately, because globalization, the perception is globalization has not delivered to millions of people around the world, and now due to the tragic consequences of the pandemic crisis, there's a lot of skepticism, not just in the US and Europe, but frankly around the world, about international agreements, be they about energy, be they about the environment, be they about banking, our subject. And so what really worries me then is that already, even before the pandemic crisis, a variety of countries, including my own here in the United States, wanted to move away from international accords such as Basel III. And I'm very fearful of that precisely because banks and non-banks indeed have millions of cross-border transactions. I'm a big believer in these kinds of international agreements to at least attempt to have uniform minimum capital, liquidity, and leverage standards. So in the US, I can tell you that those who have always been suspect of Basel III and intentionally call it a foreign agreement rather than an international one. And that linguistic nuance, it seems just like a linguistic nuance, but it's very important. Here, when bank lobbyists or Republican legislators refer to Basel III as foreign, then immediately Americans and American bankers say, well, hang on, why do we need to be implementing Basel III? And I think that's very dangerous. Whereas when you call it international, obviously we're talking about an agreement that is within nations, and the U.S. was, of course, paramount in the creation of Basel III. So this is not foreign. But I'm afraid that because of the fears of globalization and now the pandemic crisis, it's compelling many countries, including in Europe, in the U.S., and Latin America, to be more inward-looking. And so that really does put Basel III at risk. Already in the U.S., we have seen significant rollback on capital requirements, on stress testing and how rigorous they should be, liquidity and leverage ratios. And I also see easing over across the pond, as we say in Europe, and that, of course, concerns me greatly. The second theme that I would like to mention that makes Basel III 4, or if there ever is a 5 implementation, is that I concur with Ms. McDonald, who said that there's going to be defaults of mortgage borrowers in the U.S. Of course, even with a variety of legislative or different kinds of programs coming from the Federal Reserve, there's going to be defaults not only of mortgages, but all kinds of credits, such as student loans, car loans, all kinds of credit lines, and far worse than the individual defaults are, of course, the corporate ones. In the U.S., our corporate borrowers are roughly 75 to 80% equivalent of GDP. There's just been an immense amount of leverage since the financial crisis, but also because supervisors did not fully enforce the leverage lending guidance here in the U.S. And so that has meant an incredible amount of lending to companies that, frankly, should not be borrowing at levels of 5 to 6, 7 times EBITDA. And then, of course, those loans are not only covenant light, as has often been cited in the press, but they're also document light. And so what that means is that the lenders, meaning banks disproportionately, are not going to have enough protection. And that, of course, very much will impact how exactly are they going to calculate their risk-weighted assets. And will we even believe the information that's coming out? Because as the crisis intensifies, and when you have more corporate defaults and when you have more corporate downgrades, it's going to be difficult to obtain high quality data for those measurements. And so that's troublesome for the regulators. Can they rely on the accuracy of these RWAs? And can the market, investors, we need them because we depend on them for the market discipline. So that's a real problem. The third thing that will make implementation of Basel III difficult is our very, very low interest rate environment, not just in the US, but certainly globally. I mean, I cannot believe that I'm going to say this, but we've been in 2 decades of low interest rate environments that started actually with a tech meltdown back in 2000, and then with the tragedy of September 11th, and of course the financial crisis. So that has meant that banks will continue to have very significant net interest margin pressure, which of course then leads to a variety of risk-taking, both on the lending side and in the investment side. And this will continue to incentivize banks around the world to lend to already leveraged companies, leveraging individuals. It will continue to incentivize banks to invest in a wide range, not only of below investment grade bonds or securitizations, but depending on the laws that you have in your country, a lot of the banks are investing in oil companies, in almond fields, you name it. So those things are obviously incredibly illiquid and very difficult to evaluate. And so that also makes Basel III implementation very, very challenging. My fourth theme is the lack of transparency about what the Financial Stability Board refers to as other financial institutions, or what many of us refer to still is shadow financial institutions. And when I talk about lack of transparency, I'm not just talking about the lack of transparency of those institutions. I'm actually talking about the lack of transparency from the banks. How much do the banks lend to hedge funds, to private equity, to business development companies? How much do they have in derivatives? How much do they have in repos? And so that's a real big challenge, and that worries me because, of course, other financial institutions have grown very, very rapidly in continental Europe, the US, China, and even disparate parts of other kinds of emerging market countries. And banks are very interconnected to them. And so how do the banks actually assess their risk-weighted assets vis-a-vis their interconnections with all these OFIs? And I think that's something that supervisors really need to pay more attention to, and there needs to be a lot more disclosure about it. It's a theme I often hear from investors and journalists who call me. They want to know exactly how these banks are interconnected to OFIs, and what I always say is, yes, I know they are. I see it myself in my consulting and training work, but I can't give you an exact number, and that's a problem because we are in a numbers business. We need to be able to measure those risks. Lastly, a fifth theme would be that we really, really need a lot more supervision, not necessarily new regulations. I'm talking about supervision of the actual implementation of the Basel Accord. I can tell you in the US that the tone at the top has changed dramatically since President Trump came into power. And that matters because in our system, the president has a lot of power in appointing key individuals, key professionals to U.S. Treasury, which of course is what is responsible for, the Financial Stability Oversight Council. He has a lot of power in choosing his specific professionals, his specific people to the Securities and Exchange Commission, the Commodities Futures Trade Commission, and also to head very, very important posts at the Federal Reserve, the Office of the Comptroller of the Currency, and the FDIC. So when you take this all together, we can't just think about the bank regulators. They're key, of course, in implementing Basel III because, after all, Basel III is an international standard-setting agreement for banks. But you have to think of what else is going on in the respective treasuries of countries and the other, what we call financial regulators, which in our case is SEC and CFTC. Also in the U.S., we have an added complexity. We have 50 states. So guess what? We have 50 state bank regulators who, again, they get appointed by their own, governors. So all of this politicization and the influence is affected the outright deregulation going on in the U.S. And I feel very passionately about this view. This is not just tweaking the leverage ratio here, tweaking capital, tweaking liquidity, tweaking bank resolution proposals. All of that combined has meant that there's been very, very significant deregulation in the U.S. And when we're talking about the largest banking system, I should say the largest international banking system, there's obviously banks in China that are much larger, but given our banks and how they're interconnected to the United Kingdom and Europe and Asia, and that deregulation is something that should be worrying me as an American, but all of us who believe in having international banking standards. So Basel reforms have not been fully implemented in the U.S. Unfortunately, that in the last couple of years has really slowed down. And I really believe that supervisors everywhere, not just in the U.S., but all over the globe, need to be much more attentive to implementing all of the parts, all of the rules of the Basel Accord. And frankly, the credit rating agencies need to get more involved. I mean, periodically they do write reports that if they see banks, really pushing the envelope, so to speak, to, really following through some of this deregulation, that the rating agencies will call them out. Well, have they really? And so that briefly are the 5 points that I wanted to enumerate, and I want to make sure that there's time for questions. So reach out to me via mrvassociates.com. Like everybody else, I'm on LinkedIn and Twitter, but otherwise, right now I'm happy to answer any questions. Thank you so much for inviting me to participate.
Thank you. It's been a pleasure to have you on this panel. I think you brought very, very important insights into the U.S. market that we've kind of focusing on the EU, but being, as you said, such interconnected market, especially in the financial world, it's very important to hear that side of the story and how that part of the world is reacting to new sets of regulation, especially having such a complex network of different regulatory frameworks that are expected to be dealt with by different institutions out there. We are well into the next panel with the time, so all the questions that we will be receiving from our attendees, will be addressing them or forwarding them to all of you after the conference, and then I'm sure you'll be happy to address those questions after the conference. I'll be posting those Q&As on the conference website. So I want to thank you all so much. With this, we will wrap this very, very interesting second panel where we've been discussing Basel III and its implementation and challenges and what are the steps that we can expect in the future. Stay tuned because we are starting right away with our third and last